Welcome back to The Breakdown with me, NLW. It's a daily podcast on macro, Bitcoin, and the big picture power shifts remaking our world. What's going on, guys? It is Sunday, March 16th, and that means it's time for Long Read Sunday. Before we get into that, however, if you are enjoying The Breakdown, please go subscribe to it, give it a rating, give it a review, or if you want to dive deeper into the conversation, come join us on the Breakers Discord. You can find a link in the show notes or go to bit.ly/breakdownpod. All right, friends, back with another Long Reads episode. If you've been paying attention this week, the big thing happening in the world of DC crypto is a set of stablecoin bills, which have been moved now through committee, meaning that they are on the next leg of their journey to becoming law. We today have a pair of op-eds about those bills. The first is by Salah Ghazal, who is Policy and Legislative Analysis Manager at the Blockchain Association, and writes a piece simply titled, "No, the stablecoin bill isn't built for billionaires." Elizabeth Warren claims that proposed stablecoin legislation gives Elon Musk a, quote, clear runway to control U.S. money and payments. It doesn't. We're going to read that, and then we will switch to our second piece, also about stablecoins. I'll throw it over to the 11 Labs version of myself for this reading, and I will be back in just a minute.
Senator Elizabeth Warren, Massachusetts D, recently sounded the alarm over new proposals on stablecoin legislation, claiming they'd give Elon Musk a clear runway to control U.S. money and payments. If that sounds overly dramatic, it's because it is. Here's what these bills actually do. The Genius Act and the Stable Act aim to create responsible guardrails for stablecoins, ensuring consumer protection and financial stability while encouraging innovation. Far from handing the keys to a single billionaire, they lay out clear standards so that no one, the world's richest man or otherwise, can dominate payment infrastructure by sidestepping important safeguards. At their core, stablecoins are digital assets designed to maintain a constant value, most commonly tied to the US dollar and backed by a basket of reserves. However, the transparency and composition of an issuer's dollar reserves may vary, which some regulatory proposals aim to clarify. By definition, dollar-denominated stablecoins reinforce the dollar's role in the global economy rather than undermining it. Contrary to the claim that these bills would allow one person to print money, the Genius Act and Stable Act are chiefly about setting minimum reserve, auditing, and licensing standards for stablecoin issuers. The fundamental idea is to ensure transparent, fully backed stablecoins under a clear regulatory regime, not to let a tech titan mint unbacked currency at will. Stablecoins offer innovations the legacy financial system has long struggled to provide: efficient, low-cost transfers, potentially faster settlements, an ability to instantly execute transactions that can fuel new financial products. They can be sent globally in near real time, lowering barriers and giving everyday users more autonomy over their money, whether that be for remittances or payments for everyday purchases. The size of the global stablecoin ecosystem is notable and is forcing traditional financial entities into the market. The growth in transaction volumes is hard to ignore. They climbed to $710 billion in February, compared with $521 billion in the same month last year. This future of finance is an upgrade over traditional infrastructure, which is dominated by large financial institutions that often dictate costs and limit options for smaller players. By replacing cumbersome, expensive intermediaries, stablecoins empower consumers to transact more directly, preserving their privacy and autonomy without sacrificing efficiency. Stablecoins also bolster national security and support the US dollar's global dominance. The US dollar's position as the world's reserve currency provides significant geopolitical and economic advantages. With the rise of alternative financial systems, including foreign-issued digital assets, the United States must ensure that emerging technologies remain dollar-denominated. If innovators cannot operate within the US under clear rules, they may turn to foreign jurisdictions, effectively weakening the dollar's role. Encouraging stablecoin issuers to hold traditional US treasuries as backing rather than synthetic or foreign-issued substitutes helps maintain steady demand for US debt instruments and keeps the dollar anchored at the heart of global finance. At the same time, other countries are exploring strategies to reassert the dollar in ways that loop out American influence, so-called de-dollarization plans where foreign governments structure their trades and bonds in dollar equivalents without the traditional oversight or support of US institutions. If we do not modernize our own financial infrastructure, we risk losing control over the direction of dollar-based innovation. Providing a predictable regulatory framework for stablecoins helps encourage developers and businesses to keep building on US soil, ensuring that America remains at the forefront of this next wave of finance. Both the Genius Act and Stable Act propose guardrails to ensure stablecoin issuers meet baseline requirements for consumer protection and operational soundness. While each may have its strengths and weaknesses, they reflect a growing effort in Congress to produce thoughtful, bipartisan legislation. Such legislation would reduce uncertainty, spur responsible innovation, and promote healthy competition in the digital asset marketplace. By clarifying legal obligations around reserve composition, auditing, and anti-money laundering practices, these bills aim to foster an environment where stablecoins can thrive under proper oversight, protecting consumers, upholding financial stability, and supporting national security interests. Elon Musk's interest in digital payments, as with any ambitious project, highlights the larger trend. Private sector initiatives are moving rapidly, sometimes outpacing existing laws. Establishing solid regulatory foundations for stablecoins is the first step in ensuring that emerging ventures, whether they come from tech entrepreneurs or established financial giants, must operate within rules that protect the public and preserve vital U.S. interests. Proper legislation isn't about letting a billionaire corner the market. It's about providing certainty and accountability so that when a product like X Money or another innovative payment system inevitably comes along, it must meet rigorous standards for consumer protection and financial stability. The future of money is poised to be more digital, transparent, and open. By embracing stablecoin legislation, Congress can strengthen the role of the U.S. dollar, foster innovation at home, and ensure that our financial system remains safe, secure, and competitive. That outcome serves everyday consumers, fortifies national security, and preserves America's economic leadership in a rapidly evolving world.
Hello, friends. I am thrilled to share that Ledger is once again partnering and sponsoring with The Breakdown. Many of you know, but for those of you who don't, Ledger is the most secure hardware wallet for your crypto and logins. It's trusted by 7 million users and secures 20% of the world's digital assets. What's more, Ledger is a lot more than wallets. Over the recent years, they've built a comprehensive ecosystem of products and services, all of which are designed to make digital ownership more secure and accessible. You can buy your Bitcoin with Ledger and Ledger Live, and so much more. Basically, not only do they want to keep your assets secure, they want you to be able to do more with them. Ledger's newest devices, the Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your transactions and assets. Alongside Ledger Stacks and Ledger Flex, the company also launched the Ledger Security Key app, offering a safer alternative to traditional passwords and enhancing your digital security. If you are in this space, you owe it to yourself to at least check out Ledger and their ecosystem, what they have available to you. So thanks once again to Ledger for sponsoring the show. Next up, another opinion piece about stablecoins, once again with some focus on Elizabeth Warren, this time by former Senator Pat Toomey. The piece is called "Stablecoins Are a Vital Innovation That Risk Being Crushed by Misguided Fear." Rather than embracing innovation, Senator Elizabeth Warren pursues legislation that would smother stablecoins in their infancy. Once again, let's turn it over to AI, and then I will be back with a few thoughts to wrap up.
Imagine a world where every dollar you spend is tracked, approved, or denied in real time by a government agency. You attempt to send money to a friend for a political donation, but the transaction is blocked because the recipient is on a government watch list. You buy a book critical of a powerful politician, and your account is flagged for review. This dystopian future sounds outrageous, but it's the logical endpoint of a fully government-controlled and monitored monetary system for which some prominent U.S. policymakers advocate. Its defenders argue that such a government omniscient system would prevent crime. In reality, it would destroy the core freedoms of financial privacy and autonomy. Stablecoins are an existing alternative to this dystopia. They are both a major financial innovation and a bulwark against creeping financial authoritarianism. The U.S. Congress must support this technology as the Senate Banking Committee weighs legislation to provide clarity for the industry and its customers. Stablecoins, digital currencies pegged to the value of traditional currencies like the U.S. dollar, provide the benefits of cryptocurrency: fast, inexpensive, borderless, and programmable transactions without the price volatility of assets like Bitcoin. They are typically backed one-to-one with U.S. dollar cash and cash equivalents, providing stability and trust. Their programmability allows transactions to be executed automatically when specified conditions are met, unlocking enormous potential for automated finance, supply chain efficiency, and global commerce. Senators across the U.S. political spectrum, who understand the technology's current use cases and the vast future possibilities we can't yet fully envision, have proposed thoughtful legislation to guide regulations that will foster innovation while protecting consumers. This collaborative approach reflects an understanding that stablecoins could revolutionize global finance, enhance financial inclusion, and preserve the US dollar's dominance in the digital age. Unfortunately, some senators, especially Senator Elizabeth Warren of Massachusetts, stand in stark opposition to this progress. Rather than embracing innovation, she pursues legislation that would smother stablecoins in their infancy. Senator Warren paints stablecoins as tools for illicit activity, claiming they primarily facilitate fraud, drug trafficking, and terrorist financing. Her characterization is not just inaccurate, it's dangerously misleading. The data directly contradicts Senator Warren's claims. Multiple reports from blockchain analytics firms consistently show that illicit activity represents a tiny fraction of stablecoin transactions, often less than 1% of total volume. In fact, traditional cash is far more frequently used for money laundering and illicit trade than stablecoins ever have been. Blockchain technology, with its permanent and transparent ledger, actually makes illegal activity easier to track and prosecute than cash-based crime. Senator Warren's misinformed worldview leads her to advocate for a closed, government-monitored financial system, one in which every transaction is scrutinized, private financial activity becomes impossible, and access to financial tools is tightly controlled. In addition to being a morally objectionable invasion of privacy, her design would be operationally impossible to implement. It would also weaken the dollar's global dominance, as emerging economies and developing nations would turn to other digital currencies that are easier to access and use. Her constraints could not only impede the development of an important new technology, but also disrupt and harm ordinary Americans and businesses and people around the world who are using stablecoins today to move value across the internet as easily as sending an email or text message, often at a fraction of traditional costs. For example, major American corporations like Visa and PayPal are using stablecoins to settle some cross-border payments, reducing settlement times from days to minutes and lowering costs. By making dollars the default currency of the digital economy, stablecoins reinforce the dollar's role as the global reserve currency. Increased global demand for dollar-denominated stablecoins increases demand for US dollars and treasury securities, helping finance government borrowing at lower rates. In countries suffering from high inflation or capital controls, stablecoins provide ordinary citizens with a safe, dollar-denominated savings option, protecting their wealth from economic mismanagement. Migrant workers sending money home can do so more quickly, inexpensively, and more reliably with stablecoins than through traditional remittance services, which often charge exorbitant fees. The Warren vision rejects the open, public, universally accessible system being developed today, a system where individuals and businesses alike can transact freely, without needing permission from banks or governments. Fortunately, there is still hope for a balanced regulatory approach. A group of senators have introduced the Bipartisan Genius Act, which would create a constructive regulatory framework for stablecoins that addresses legitimate concerns while enabling innovation. The Genius Act and the White House Executive Order on Strengthening American Leadership in Digital Financial Technology will both ensure that the benefits of blockchain technology can be fully realized on open, freely accessible, and transparent public blockchains. Congress must embrace stablecoins, not fear them. The future of money is being written today. Will the United States lead this transformation, ensuring that digital dollars remain the global standard? Or will fear, misinformation, and stifling regulation hand the future of finance to other nations? The choice is clear. Support innovation, enact smart regulation, and let stablecoins flourish.
All right, back to Real NLW here. So clearly there are some common themes between these bills, both in terms of their pro-stablecoin stance and their explaining what this legislation actually does, as well as their quite reasonable focus on Elizabeth Warren as the antagonist. What's interesting about this moment is that I have never felt so much like someone was an artifact of the past as now looking at Elizabeth Warren when it comes to crypto policy. No, of course, that doesn't mean we shouldn't take her seriously. She still has a lot of followers. She still has a lot of friends and allies. She still has a lot of clout when it comes to financial policy. However, no one has more had their view of the crypto industry absolutely defeated and moved on from over the last couple of years than Elizabeth Warren. She had a free hand during the Biden administration to push for the end of this industry, and it didn't work. The rest of the world is moving on with the knowledge that digital money just makes sense. Huge numbers of Democrats, particularly younger Democrats, simply don't care about the old battles and the old wars that the old guard like Warren still want to fight. They're ready to look forward, not backward. It's very encouraging, even in this moment of chaos and transition, and I will leave you with that positive thought. Appreciate you guys listening as always, and until next time, be safe and take care of each other. Peace